acquisition of RateSetter by Metro Bank, which proved our title right. And it's my pleasure today to be joined by the best person to discuss this topic. We've got Daniel Frumkin, who's the CEO of Metro Bank. Hi, Daniel. How are you?
I'm good. How about yourself, Oliver?
Very good, thank you. Very good. You might have heard the conversation just before. We've had some really interesting chats today, covering lots of ground, CBILS and BIBLs being the last two sessions. But first of all, to sort of set some ground for our audience, I'd love it if you could talk us through the RateSetter acquisition, and I guess in particular the logic of Metro Bank acquiring this lender.
Yeah, I think. Listen, Oliver. I think it's really at the nub of why did we do the transaction? So the reality is that we ended up going into COVID lockdown in March, and the Bank of England reduced the base rate to 0.1%. And we're left looking at a business model that was going to have, because of COVID, a bit higher cost, lower fee income because really nobody was doing anything. No travel, which meant no FX, no real activity at all. We were going to have higher provision expense because just the nature, unfortunately, there's a lot of people struggling through this very difficult time. And we should never lose sight of that fact, that this is really a difficult period for lots of folks. And we were staring at something that was probably more of a medium-term problem than a transitionary problem. And that is, we anticipate low interest rates at the Bank of England to be something that stays in place for at least a handful of years. Yeah, and I think that's the reality. So we stepped back and we said, okay, what parts of our strategy, which we laid out in February, literally a month before COVID, what parts of our strategy do we want to revisit? What parts do we want to back away from? And what parts do we want to accelerate? And through those conversations at board level and amongst the executive, it became pretty clear that accelerating some of our lending initiatives, be that specialist mortgages or unsecured personal lending, was important and more important in a low rate environment. So, okay, so you cross that bridge and say, okay, we want to do more unsecured personal lending quicker. If that's the problem statement, you start to look around the marketplace and say, how can we make that happen? Can we build it ourselves? What would it take to build it ourselves? How quickly? Who would we hire in? Who could we poach from another organization? What does that look like? And then you start to think about what we could potentially acquire. And so sort of a buy versus build conversation. And it became pretty clear to us that there were a few people in the unsecured personal lending, the sort of, personal finance space that had great business models, really, really good people, pretty good kit and tech, but had really hit a point where the fundamental funding vehicle for those business models was under threat, right? I mean, it's really difficult in this current environment to make all of that work. So yeah, I think that was the logic of how we ended up scanning the horizon for peer-to-peer lenders and what peer-to-peer lenders were out in the marketplace. And, there are several, all of which I assume and it became pretty clear that RateSetter was pretty uniquely positioned in that space. I mean, I think they were the second largest unsecured personal lender from a peer-to-peer perspective after Zopa. They've been around for a decade. They have lots of good data, lots of good risk people, lots of good product people, lots of good IT people. Ridian is, he's great and he's really knowledgeable about the business, and his top team, Pete and Mike and the team there are really good. So we were really thrilled to have the opportunity to have the conversation with them, and that's sort of how it started.
Fantastic. You mentioned the technology, and I'm going to ask you some questions on integration in a moment. But first of all, just give us a bit of a timeline. It sounds like this deal or the search began at the start of 2020. Could you kind of paint the timeline of the deal?
Yeah, Oliver, it's even tighter than that. So I talked to Ridian for the first time in the middle of May.
Okay.
So it came together very quickly. I still haven't broken bread with Ridian, so we've not had a meal together in this whole time. So we've not even met face to face in any way. So it wasn't until middle of May where we came to a conclusion that buying versus building made sense. And then we did a market scan. We alighted on RateSetter. So it really came together very quick. From middle of May to closing in September, it was 4 months, and we really agreed the deal with inside of 6 or 7 weeks. So I think Ridian and the RateSetter team got the logic of merging with something like Metrobank. We have really low cost funding, and we have more liquidity than we know what to do with. We have plenty of capital. Some of the constraints RateSetter was feeling, and a lot of actually the alternate finance providers feel, Metro really addresses. And then I think there was real cultural alignment. So the thing about Metro is, we're new, right? We're 10 years old. We're broadly still entrepreneurial. We came into existence to disrupt the retail banking market. So a lot of the same ethos that RateSetter ascribes itself to, Metro ascribes itself to. So the cultural fit was pretty quick. So it really came together very fast.
That's amazing. We've spoken to some VCs over the last 6 months who say they won't sign a term sheet without meeting, the team and the founder, and you managed to complete an acquisition without meeting them, which is pretty amazing. I want to, some of the themes you've just touched on make it sound like the deal was almost inevitable. And I guess it jumps forward slightly in my questioning, but do you expect these kinds of deals, more of them, to come in the future from other banks looking at other originators?
So it's so serious economic disruptions, and I've never lived through anything like COVID, right? So COVID, in terms of its economic impact and its health impact, is something I don't even think. It's the stuff of horror movies, right? It's the stuff of sci-fi novels. So, but overall, meaningful economic disruptions lead to changes in landscapes. They and it's just inevitable. And I think financial services won't be immune from that. It'll be the airline industry. It'll be, Rolls-Royce engines. The disruption will be felt across many industries, and I think finance is one of them. And that means, yes, I think there'll be some consolidation, and there'll be people choosing different models, and I think that's somewhat inevitable over time. But I don't think it'll be as prevalent as people think. I think people think, oh, this means the end of, the peer-to-peer model, or this is the end of that kind of draconian language isn't really helpful, because it's not true. What it really means is that people will just be revisiting their business models and figuring out the best strategy going forward. It doesn't mean that independence won't still exist. And you have places like Zopa, right? Zopa's done actually. They went and got a banking license. They got a bunch of PE backing for that to be able to enable them to get the license. They're now offering savings accounts and everything else. So I think you'll see a bunch of different models emerge, but inevitably there will be some consolidation. Yeah.
Interesting. You mentioned technology, and I guess not so much about technology, but the acquisition is complete now. I think it's got the green light from the regulator. What does this mean for the integration of the two businesses? You've got obviously two separate standalone brands. What does it mean for the back office technology stack? And how are Metrobank handling that?
Yeah, again, it's a bit of a unique situation, because what we bought, we wanted, right? So we wanted the people, we wanted the infrastructure, we wanted the systems, data, all that. So it's a slightly different type of integration. I don't know, RateSetter is probably my 30th or 35th acquisition. So I've done more than a few. And it's unique in its integration because of our desire to have the functionality it already possessed. So we closed it in September, and we underwrote our first RateSetter loan, where we funded it, Metro funded it, in October. So within 30 days, it might have been 40, but within sort of 40 days, we were originating unsecured personal lending. So you will see RateSetter on the aggregator sites as we speak today. We're just sort of testing the waters and learning a bit. So we're not doing huge volume because we don't want to, but we're back out lending already. And I think the trick in the integration is how we take the real skill set that's possessed at RateSetter and the real talent and leverage it up within the Metrobank brand. So Metrobank really wasn't a very good unsecured personal lender. So, there's huge room for improvement on credit cards and overdrafts and small business lending that the team at RateSetter can help us with, which we're excited about. In terms of IT, it's interesting actually. So the thing RateSetter did, it had near shored a chunk of its IT infrastructure, which actually brought its cost to deliver down pretty meaningfully. And Metro's on that journey, and RateSetter was a bit ahead of us. So there's no reason why we wouldn't leverage up what RateSetter's done and move forward. They have a service center in Leicester. Well, I mean, I guess technically they have a service center at the moment in everybody's front sitting room. But at the end of the day, when world returns to normal, they have a service center in Leicester that we're excited about. They have some collection expertise. They have some ability to process consumer credit that is better than ours. So we're really excited about the Leicester opportunity, and we're going to leverage it up. So it's not your typical kind of overlap cost out acquisition where, we're going to come in and they have X number, 250, colleagues, and we're going to take 100 of them out, and it's going to be 150 colleagues, and we're going to convert all their IT onto Metro's IT. And no, that's not what this is about. This is about how we use the skill set and the people to help Metro grow quicker.
Interesting. So in terms of managing the RateSetter business, it's being managed sort of slightly at arm's length as a standalone sort of group, I guess. I know everyone's at home, so obviously it's sort of at arm's length, but it's being managed, I guess, separately from core Metro.
Yeah. So Ridian sits on Exco. Yeah. And he, so he's one of my direct reports, and he's one of 13 people on Exco and is there to represent RateSetter. Inevitably through the integration, we don't, the legal teams need to come together. The people team needs to come together. We've got to decide what we do about risk and whether it's the first line risk or the second line risk. We have some of those conversations. But fundamentally, RateSetter will own a suite of products on behalf of Metro Bank. Unsecured personal lending is the obvious example. And they will be able to do unsecured personal lending both under the RateSetter brand and under the Metro Bank brand. So we fully anticipate that in essence, RateSetter will white label for Metro Bank, right? I mean, in essence, we'll use their kit to be able to do unsecured personal lending through our stores, through our digital offering, and then eventually through the telephones. And we'll continue to use the RateSetter brand on aggregator sites and continue to generate volume both direct under RateSetter and through aggregator sites. So yeah, it should give them more breadth to play with. They have a whole nother distribution channel and a whole nother brand to help them be more successful in generating lending volume.
Interesting. Well, very excited to see how it goes. On RateSetter's lending operation, there's obviously, you've mentioned unsecured consumer lending. There's obviously also, there's some property and there's some vehicle lending in there as well. What does this mean for the future of those two products?
Yeah, it's. I think the best I can say, it's under review. So the issue is, so for unsecured personal lending, we didn't do much of it. I mean, we probably had less than 20 million outstanding of unsecured personal lending on a 21 billion pound balance sheet. So we really didn't do very much of it at all. That's not really true about property finance. I mean, we have a proper CRE, commercial real estate lending, property finance business as part of the bank. So that there's probably more overlap, like who's doing what and why, and some of the transactions RateSetter might have done, we might have seen and chosen not to do. So it just becomes a bit more complicated. Yeah. And the auto finance, we've just got to decide if it's a business we want to be in. Like, so if it is a business we want to be in, we're going to want it to be much bigger because it's too small to make a difference to Metro. So we'll start thinking about whether we scale that up or exit it. So I think both of those businesses are sort of under review while we try to figure out how they fit within Metro, because it's not as seamless as the unsecured personal lending. They're a little bit more difficult in that regard. Interesting.
There's some audience questions coming through. I'm gonna pull some of those in because I want to make sure that all the topics get covered. First question is from Jay Tickham, who's asked, do you see more P2P acquisitions by banks or more IPOs like Funding Circle? You touched on the acquisitions a little bit. I think you've answered that question, but the IPOs like Funding Circle, could you touch on that?
Yeah. So Oliver, I think it's really hard to see financial services company being sort of a new financial services company listing a peer-to-peer lender and actually raising equity that way. It'd be difficult. The market's very tough. I mean, you have Lloyd's Bank. I mean, I know it's rallied, but I still think it's trading at like 0.3 of book or something. I mean, it's really hard to envision that the equity markets are open just at this juncture for a pure P2P play. Now, those folks doing payment stuff, and there's a bunch of really good fintech out there that absolutely has access to markets, but I'm not sure a pure peer-to-peer player has that today. And the acquisition stuff, I don't know. We'll just have to wait and see how it unfolds. Yeah.
Adam Marks has asked. Obviously, the BCR funding was a huge injection into the SME lending and SME banking area. How is Metro progressing against its BCR targets at the moment?
Yeah, we're on track for our public commitments, and even there's some non-public commitments, and we continue to deliver. And it's made a difference. I'll give you an example. So it's not a BCR commitment, but Bibbles, right? So you did Bibbles just before this.
Yeah.
And Metro Bank, from a standing start, didn't have any of the infrastructure, wasn't really consulted by the British Business Bank early in the process, unlike the big banks. We've almost done 40,000 Bibbles loans and almost $1.5 billion of lending from a standing start. We would not have been able to do that without the BCR commitments and some of the infrastructure we started to build. So we repurposed some of that infrastructure. So it wasn't exactly the infrastructure we were building for BCR, but had we not started down that journey, we wouldn't have been able to actually participate in Bibbles. And the whole concept behind BCR and the C&I fund is to create competition, to try to give SMEs another alternative. And there's a perfect example where, I think we're the 5th or 6th largest lender for Bibbles in the UK. We trail the big four, and there's a debate about whether we trail Santander or not. So the reality is that, I think that was the whole intent behind BCR and the remedies. And I think that's a living example of how actually having access to that money allowed Metro to be a much better competitor at the time it needed to be one. Yeah.
My colleague Daniel Lanyons posted a question, and he's asked, how does Metro Bank see itself in comparison with the rise of digital-only challenges like Monzo and Starling? Just to add context, we had Anne on yesterday, and obviously she's got her new book out. You might have spotted it. She actually has some really positive words of praise of Metro and the branch-based model and how that was, really pushing the industry forward. I guess when you look at branchless, let's call them branchless banks, what do you think about those at the moment?
Yeah. So listen, I have a lot of time for Anne. So I think she's done really well, actually. And I think Starling does a really good job at what it does. And I've got really nothing negative to say. I do think, however, there is a fundamental difference between what Starling's trying to build, what Monzo's built, what you can go down the list, has built. I think we're one of the few challenger banks, and probably the only startup challenger bank, that really has tried to build a full service financial institution. So we do corporate lending, we do large corporate lending, we do SME lending, we offer current accounts, savings accounts, we offer the whole. So if you walk into one of our stores or you come to us digitally, we have almost the same level of service that you would find in the retail bank of NatWest or in, and I think that separates us a bit. I think the store footprint separates us a bit. We believe fundamentally that the customer, fans in our language, should be able to choose their channel. So if they want to come in, then they should be able to physically come into a store. We find that really appealing in the SME space in particular. We're finding the 7-day-a-week banking, the extended hours really does appeal to the SME sector. But so it doesn't mean we don't invest in digital. We just launched our digital business account opening, and we compared it against Tide, and we think it's, obviously I'd say it, but we think it's as good as Tide and almost as quick. And we went through number of clicks and number of seconds, and we did all of those measurements. So we really do invest in all our channels. But we think having all the channels is, again, makes us a more full service competitor. I honestly think some of the digital only players will carve out really good niches, and I think they'll be very successful, but I'm not sure they can be a true threat to the established large banks, because there are things that people want to go into store for. We published some of that research. I don't know if you saw it, Oliver, but we did during the lockdown. It's a very large percentage of customers who want to have the ability to go into store. Almost, I think it's over 60% from memory. So it's a large percentage of customers who want to go. That doesn't mean they'll ever go in. That's a very different statement. It just means they want to have the ability to go in. Yeah.
Well, that leads nicely on to my next question, which I imagine will be a very quick, short answer from yourself. Someone's asked about post-COVID, the having a network of branches. Still very much part of the core Metro strategy, still dedicated to that?
Yeah. Listen, we have 77 stores, and they've all been chosen, almost all of them been chosen in the last 6 or 7 years. They're in locations we want to be in. We think there are locations over the medium term that'll be really strong. We're completely committed to the store estate. But, 5 or 7 years from now, has COVID fundamentally altered the high street? I don't know, Oliver. I can't answer that question. So we'll stay flexible as we go forward. We'll probably open a bit fewer stores over the next couple of years while we figure out, what the high street is and whether, out of town locations are better with drive-throughs. But we're completely committed to stores. Yeah.
Excellent. Last question from Lewis Harris. He asks, you mentioned that RateSetter has a lower cost to acquire than Metrobank. Are Metro looking to partner with fintechs to streamline the current processes, or are you looking to build fintechs? And I guess it also chives, someone else said, are you looking for future acquisitions or partnerships?
Yeah. So the short answer is yes. We're always open to creative, interesting ideas. We're also really open to fintechs who find that their business model has been so effective that actually tucking inside a large organization makes sense. We're completely open to kind of an independent model, a bit like RateSetter. So we love entrepreneurism. We want people to continue to grow and be successful. So they can do that as part of the Metro family. So we're completely open to that. And then, we do use partners already. So EasyBob, which is a pretty well-known fintech, they've really helped us build out our SME lending platform. They've been a big part of how we've built out our Bibbles and small business lending platform. So we do partner with fintechs. We're pretty committed to trying to help the overall ecosystem of the UK be successful, because at the end of the day, Metro's only as good as the macro economy. And anything that helps the macro economy grow is net good for Metro. Yeah.
Fantastic. Dan, thank you so much for being here with us today. Thank you for tackling all of our audience questions. Good luck with the rest of the integration with RateSetter. We look forward to seeing how that goes. And until we meet next time.
That's great. Oliver, take care now. Thanks for the time.
Thanks,
cheers,
Dan.
man.
And we'll be back in just 2 minutes' time. We're going to be talking about automation, onboarding, and the latest developments in our next session, Speed is of the Essence.